All right, welcome to this explainer on Peter Lynch's legendary investing philosophy, One Up on Wall Street. Today, we're going to reveal why your everyday life, just as a regular consumer, is actually your ultimate secret weapon for the stock market. The financial world, it often feels like this super exclusive club, right? Locked away behind complex jargon and massive trading desks. But Peter Lynch, who, by the way, managed the Fidelity Magellan Fund to an absolutely staggering 29% average annual return for 13 years, he completely flipped that script. He believed that the absolute best stock research happens when you're literally just out there living your life, buying groceries, driving your car, or just working at your job.
So we're kicking things off with a pretty rebellious piece of advice from a legendary Wall Street insider. Stop listening to professionals. After 20 years in the business, Lynch was completely convinced that any normal person, using just like 3% of their brain power, can pick stocks just as well as, or honestly even better than, your average Wall Street expert. And look, I know what you're thinking. You wouldn't ask a plumber to do your dental work, but investing, it's not plumbing. This is an arena where the smart money really isn't always so smart, and the dumb money is only dumb when it blindly follows those so-called experts.
So here's our step-by-step playbook for today. 1. The amateur's edge. 2. Preparing to invest. 3. Stalking the 10-bagger. 4. Doing your homework. And 5. The long-term view. Let's jump right in.
Section 1, the amateur's edge. You really have to notice the stark contrast between these two. While the pros are out there managing billions of dollars, they're actually boxed in by super strict institutional rules, union restrictions, and SEC limits on how much of a company they can even own. Plus, they suffer from what's called street lag. That just means a really promising company might not even hit an analyst's radar until it's already a massive success. But you, the free amateur, you're agile. You can just look around your local mall, notice a store that is constantly packed, and spot a massive trend months or literally years before Wall Street officially certifies it. Best of all, you don't have a boss breathing down your neck, criticizing you for buying some unknown stock.
Moving on to Section 2, preparing to invest.
Now, before you go out and buy a single stock, you absolutely must pass what Lynch calls the mirror test. Literally, look in the mirror and ask yourself 3 things. Number 1, do I own a house? See, a house is an investment almost everyone succeeds at, mostly because you hold on to it for a long time and inspect it super carefully before buying. Number 2, do I need the money? Listen, if you need this cash to pay your kids' college tuition in 2 years, keep it out of the market. Seriously, stocks can drop and stay down for years. And number 3, do I have the temperament? You need patience, common sense, and the detachment to just ignore your gut feelings and the inevitable market panic. If you're the type to panic sell the second the market drops, well, you probably shouldn't be in stocks.
Okay, Section 3, stalking the 10-bagger. We're borrowing a term from baseball here, the 10-bagger. In baseball, a home run is a 4-bagger, right? Well, in investing, a 10-bagger is a stock where you make 10 times your initial money. It's the holy grail. And the really beautiful secret here, you'll often find these massive winners in incredibly familiar, everyday places. You don't need some fancy Wall Street terminal to find them. I mean, Lynch literally stumbled upon big winners just by eating a really great burrito at Taco Bell or noticing how much he loved the coffee at Dunkin' Donuts.
Take Legs pantyhose back in the 1970s. Lynch's wife, Carolyn, actually discovered them, and not by reading complex financial reports, but just by going to the grocery store and realizing, wow, this is a vastly superior product. Just ordinary observation of its supermarket success could have easily tripled your money. You didn't need to be some specialized textile analyst agonizing over profit margins and factory outputs. You just had to notice a best-selling product sitting right there in front of you.
Now, once you do spot a promising company using that consumer edge of yours, you've got to classify it. Lynch breaks stocks down into 6 distinct categories. First, you have your slow growers, which are huge, mature companies. Then stalwarts, like Coca-Cola. These offer steady protection when recessions hit. Next are the fast growers. These are smaller, super aggressive companies growing at like 20% a year. This is exactly where those 10-baggers live, by the way. Then you've got cyclicals, like auto companies, that rise and fall with the broader economy. Turnarounds, which are companies bouncing back from the brink of disaster. And finally, asset plays, which are companies sitting on highly valuable real estate or cash. Categorizing your stock is absolutely crucial because you have to manage a safe stalwart very differently than a high-risk fast grower. So what exactly does the ideal Peter Lynch prospect look like? Well, counterintuitively, the perfect stock often sounds absolutely terrible. It might have a totally ridiculous name, like Pet Boys, Or it operates in a really dull or even slightly disgusting industry. Think oil drum retrieval or waste management. See, Wall Street analysts actively ignore these boring, disagreeable companies, especially if there are, say, crazy rumors swirling around about toxic waste or mafia ties. But this lack of professional attention, it keeps the stock price artificially low, and that gives the amateur plenty of time to buy in before the massive institutions finally catch on and drive the price to the moon.
All right, Section 4, doing your homework.
Spotting a great company is just the first step. Now you have to look at the numbers, and a really crucial starting point is understanding the PE, or price-to-earnings ratio. This is a super vital numerical shorthand. Just think of it simply as how many years will it take for the company to earn back your initial investment? So a PE of 2 means it takes 2 years. A PE of 40 means it takes 40 years. Generally speaking, you really want to avoid stocks with excessively high PE ratios, just because they carry way too much heavy expectation. If a PE ratio is roughly equal to the company's growth rate, you're usually in pretty good shape. Next, you absolutely must differentiate between two very different market forces. Over the long run, earnings dictate everything. Let me repeat that. Earnings dictate everything. If a company continues to earn more money, its stock price will eventually follow. That is true business success. Conversely, those short-term stock price wiggles, they're driven by market panic, wild economic predictions, and just random daily fluctuations. They're completely unpredictable, and honestly, they're entirely distracting. Focus on the earnings, not the daily wiggles. Now for the financial health check. Look, don't be intimidated by the balance sheet. Just look for a few key things. Number 1, does the cash exceed the long-term debt? If yes, the company is strong and likely won't go bankrupt anytime soon. Are inventories piling up faster than sales? Keep an eye out for that, because that's a major red flag. Also, check out their dividend record, especially during recessions. And finally, are they buying back their own shares? Share buybacks actually reduce the number of shares in circulation, which magically boosts the earnings per share and directly rewards you, the investor.
And that brings us to our final section, Section 5, the long-term view.
So how many stocks should you actually own? Well, Lynch recommends maintaining a pretty manageable portfolio size, somewhere between 3 to 10 stocks. For example, a really healthy 5-stock amateur spread might look a bit like this. You see, you don't want to put all your eggs in one basket, sure, but you also shouldn't diversify into a bunch of unknown companies just for the sake of it. By blending the categories we talked about earlier, say holding a couple of aggressive fast growers, balancing them out with a steady stalwart, and maybe sprinkling in a cyclical and an asset play, you end up balancing your risk and reward beautifully.
Now, let's talk about the harsh reality of weathering the market, because to succeed long-term, you really have to follow these 3 steps. Step 1, ignore macroeconomic predictions. Seriously, nobody can accurately predict the next recession or the next massive market drop. Step 2, endure the drawdowns. The market has collapsed before, and guess what? It's gonna collapse again. When it drops, don't panic. View it as a fantastic opportunity to buy really solid merchandise on sale. And step 3, prune based on fundamentals. You should only rotate your stocks when the company's actual story changes, like if their balance sheet gets worse or their growth suddenly stalls out. Never sell just because the overall stock market happens to be having a bad day.
And I have to share this quote with you. It's so famous that even Warren Buffett actually called Peter Lynch just to compliment him on it. Lynch brilliantly compares portfolio management to gardening. He says, when you sell your great companies and add to the losers, it's like watering the weeds and cutting the flowers. It is such a massive common mistake amateur investors make, cashing out their big winners just to pour that hard-earned money back into a falling stock, hoping it'll magically bounce back. If the story of your winning company is still strong, hold on to it. Let the flowers bloom. Wow, okay, we've covered a tremendous amount of ground today in this explainer, from the sheer power of the amateur edge to identifying the perfect stocks, doing that crucial fundamental homework, and finally, holding steady for the long haul. So I want to leave you with this one thought. The next time you're out running errands, just look closely at the businesses you already love. What are you buying? What is everyone else around you buying? Because your very next mundane purchase might actually hold the key to your financial future. So tell me, what hidden 10-bagger is sitting in your shopping cart right now?